In this video, we're diving into gamma in options trading. If you've heard about the Greeks in trading, you might know that they're a set of measures to help us understand risk, reward, and the behavior of options. Gamma is one of these Greeks, and it's especially important because it influences how options respond to price movements. So let's get into what gamma is, why it's useful, and what it means to be either long gamma or short gamma in a position. Gamma is what we call a secondary Greek. It measures the rate of change in another Greek called delta, which tells us how much an options price moves when the stock price changes. Think of delta as showing how sensitive the option is to a move in the stock price. Gamma then shows us how fast this sensitivity is changing. Knowing your gamma exposure is essential because it impacts how your position behaves as the stock price moves. So let's explore what it means to be either long or short gamma. If you're net long options, then you're also long gamma. This can sound technical, but here's a simple way to look at it. In a long gamma position, you want the stock price to move. Long gamma positions are essentially directional bets. You benefit from volatility, meaning that if the stock price moves up or down significantly, your position stands to profit. However, long gamma also usually means a short theta position, which means you're fighting time decay. Now, time decay, or theta, is a measure of how the options value declines as time passes. When you're short theta, this time decay is working against you. If the stock doesn't move in your favor, you'll gradually lose value just because of time passing. Common strategies that make you long gamma include long calls, long puts, and directional vertical spreads. Long calls and long puts are straightforward directional bets. When you buy calls or puts, you're hoping for the stock price to move significantly up or down. Directional verticals involve buying and selling options at different strike prices, but in the same direction, like a bull call spread. This structure profits from movement in a specific direction, so it's also a long gamma setup. Now let's talk about what it means to be net short gamma. When you're short options, you're also typically short gamma. Simply put, if you're in a short gamma position, you don't need the stock to move to make a profit. In fact, a stable or a range-bound price is what you're hoping for. Short gamma positions are non-directional, meaning they don't require a specific price movement. And unlike long gamma, short gamma usually means a long theta position. This is where time decay is actually helping you. As each day passes without significant movement, time decay gradually adds value to your position. Some strategies that make you short gamma include short calls, short puts, and non-directional vertical spreads. By selling calls or puts, you're betting that the stock price will stay relatively stable. You don't need much movement because you're relying on time decay. Common non-directional vertical spreads include credit spreads, like a bear call spread, where you profit if the stock stays below a certain level. These strategies don't need movement, and they benefit from time decay working in your favor. Now let's discuss some characteristics of gamma that apply to both long and short gamma positions. Gamma is highest on at-the-money options. When the stock's strike price is close to the stock's market price, gamma is at its peak, meaning the option's sensitivity to stock price changes is most pronounced. An option position that has a high gamma has potential to have large swings in its profit or loss. And this is because a relatively small change in stock price can cause a significant change in the delta of a position. In a long gamma position, your exposure to potential gains actually increases as the stock moves in your favor. This means that as the stock price moves up or down, the delta of your position adjusts in a way that can amplify your profits if the move is strong enough.
For example, let's say you have an option with a delta of 56. This option has a gamma of 1.5. If the stock moves up $1, you would take that gamma and add it to the delta, leaving you with a delta of 57.5. As the stock continues to go up, your delta will increase. If the stock goes down, you subtract the gamma from the delta, and the delta number will get smaller, thus reducing your overall exposure.
In a short gamma position, your exposure decreases as the stock moves in your favor. So a small price move in the expected direction reduces the impact of further changes, limiting your potential reward. Conversely, a short gamma position that moves against you can actually accelerate and lead to larger potential losses. Gamma is a vital Greek for any options trader to understand. It shows how an option's price sensitivity to the stock price changes over time. Whether you're long or short gamma has big implications for how you make money on a position. So ask yourself, are you looking for the stock to move or are you betting on stability? Long gamma strategies like long calls, long puts, or directional verticals are for when you expect price movement and volatility. Meanwhile, short gamma strategies like short calls, short puts, and non-directional verticals are for when you're aiming for stability and you want time decay on your side.